High-deductible healthcare plans and health savings accounts. You've all heard about them, whether you've heard them referred to as HDHPs, consumer-driven plans, or HSAs. But are you clear on how they work and how they allow for more control of your healthcare dollars? Do you want to take a more active role in saving for medical expenses and take greater control of your healthcare expenses? A high-deductible health plan is one solution. With this type of medical plan, you're going to see how you can spend less on healthcare premiums, the amount taken out of your paycheck, in exchange for paying in full for your medical expenses up to a certain level called the deductible. After you reach that deductible level, the plan begins to pay for expenses. In addition to paying less for your premiums, you're able to set up a tax-free account to pay for expenses. High-deductible plans help you to be more aware of the cost of healthcare, creating an opportunity for you to make purposeful decisions on services and providers. When you are responsible for the entire cost prior to meeting the deductible, you will likely engage more in your health, in your plan, and in your total budget for medical expenses. We're going to go over this type of plan, and we'll make sure that by the time you finish watching, you'll know the key facts about a qualified high-deductible health plan with a health savings account. What is a high-deductible health plan? The high-deductible health plan is exactly what the name states. The deductible is higher with this type of plan than with a traditional plan. Here's how it works. You pay a lower amount out of your paycheck and only pay for services if and when you need them. You are responsible for any medical costs prior to meeting the deductible, except for preventive services like physicals, which are covered at 100%. Now let's get more specific. An HDHP has 4 main components. The first component is preventive care. Preventive care consists of physicals, adult exams, preventive lab work and radiology, childhood immunizations, and well woman exams. All of the things that keep you from getting sick in the first place fit into this category. The health plan pays 100% of preventive care. These visits are not subject to your deductible or your out-of-pocket maximum expense, so you have no excuses not to get those yearly physicals and stay healthy. But remember to talk to your doctor. To qualify as preventive, the visit must result in no diagnosis and cannot be linked to a medical condition. The second component of an HDHP is your annual deductible. Your annual deductible is the amount you pay out of pocket before your health benefits coverage begins. Since the deductible is higher under this plan, the IRS has created a funding vehicle to help you pay for medical expenses. That funding vehicle is the third component called a health savings account, or HSA. The HSA is an individual bank account created exclusively for you and allows you to save a portion of your paycheck pre-tax to pay for your deductible fees and other qualifying expenses. You can use the funds in your HSA for medical, dental, and vision expenses, as well as some expenses that may not be covered by your plan. Expenses that are not covered by the medical plan do not count toward the deductible. The fourth component of your HDHP is simply your health insurance coverage, the negotiated rates and discounts provided as part of your health plan. Remember, you will want to see a network provider to get the medical plan discounted rates. With a high-deductible health plan and a health savings account, all of your covered medical costs apply to your maximum out-of-pocket expenses. Review your plan summary to determine your specific maximum out-of-pocket expenses. You cannot spend more than these defined amounts out of your own pocket through your health plan coverage. You may be wondering, how will this benefit me? With an HSA, you can pay yourself, and if you don't use the funds by year's end, then you can use them next year. This plan can work for anyone. And keep in mind, the money you're putting into your HSA is pre-tax. Also, while your money is in the account, it's earning interest and building for future healthcare expenses and retirement. Okay, so how do you fund your HSA? There are 2 ways. The first way is through your employer. Some employers choose to help fund this account. This varies by employer. If your employer does help fund your HSA account, the money will be directly deposited. The second way to fund your account is a direct deposit from your paycheck. The money will also be automatically put into your account, and you won't have to pay taxes on the money. These are the maximum contributions you can make if you're single or if you have a family. The limits include both your contributions and any contributions your employer makes to your account. If you are age 55 or older, you may make an additional contribution called a catch-up contribution. You can use the accumulated funds in your HSA to reimburse IRS-approved expenses, including prescription medications, over-the-counter medications with a physician prescription, exams and tests, dental, vision, COBRA premiums, long-term care premiums, retiree health insurance premiums if you're 65 and older, and more. The money in your HSA can be used to reimburse these expenses for you and any of your IRS dependents. Your health benefits plan may define dependent eligibility differently than IRS guidelines. Talk with your employer about your specific dependent eligibility rules. The IRS has rules and regulations regarding HSAs. Let's go over those now. Some people are not eligible to participate in an HSA. If you are also enrolled in a non-high deductible health plan through your spouse or another source, you do not qualify for an HSA. Your dependents, however, can have other coverage. If you can be claimed on someone else's taxes as a dependent, you cannot make contributions to an HSA. You cannot maintain an FSA and an HSA at the same time for medical expenses. You have to decide on one or the other. If your spouse is contributing to an FSA, you aren't eligible. And lastly, if you have already made maximum contributions to an HSA in the same plan year, you do not qualify. For those who are near or have reached Medicare age of 65, there are many different scenarios, so you will want to confirm your situation prior to enrolling. But generally, if you are enrolled in any portion of Medicare, you cannot participate in the HSA portion. If an eligible dependent is enrolled in Medicare, then you can. Now let's talk about using the funds in the HSA correctly. Since the money you put into an HSA is pre-tax and deferring taxes on the interest, the IRS has rules about taking the money out. If you misuse your HSA and pull out money for unqualified medical expenses, the IRS will penalize you. If you decide to take some money out for a cruise and the IRS finds out through a traditional individual audit, you will have to pay a 20% excise tax and income taxes on the money you put in, as well as on the interest it earned. Nobody will ever stop you from taking money out of your HSA. It's your money in your account, but always save your receipts. That way, if you do get audited, you can prove where the money went. After you're 65 years old, the rules change a little. You can pull the money out for any reason and will not have any IRS penalties or excise tax. However, you will have to pay income tax on that money. Your HSA is both flexible and portable. You can reimburse yourself immediately every time you have an expense, or you can save all your receipts in a shoebox, let your money earn interest, and then pay yourself back all at once in one big lump sum. You have ultimate control of every penny in the account. Let's say you choose a high-deductible healthcare plan with an HSA this year, but next year you decide to go back to a traditional plan. You can simply use the money in your HSA for your copays, prescriptions, over-the-counter medications, and any other qualified expenses. The money never goes away, and as long as it is being used for qualifying expenses, will never be taxed nor have penalties. Okay, so what if you quit, lose your position, or change jobs? The account goes with you. You can continue to invest the money in the account or withdraw it for qualifying expenses, but you cannot make any new contributions unless you become enrolled in another high-deductible health plan. So, when it all comes down to it, and you actually go to see your doctor, how does it work? Well, it's pretty easy. You simply make your appointment, go see your doctor, and remember that you have no copay. So you show them your health plan ID card, and the doctor will bill your insurance provider. You will then get an explanation of benefits in the mail from your insurer. You may get an initial bill from your provider before you get the explanation of benefits. Do not pay this bill. Wait until you get your explanation of benefits, because it will explain how the health plan discounted the services you received. With this information, you can be confident you are paying the correct amount. Once you get the correct amount due, you can send a check, pay cash, or use the debit card that comes with your health savings account and pay the provider directly from the account. Or you can set up a payment plan. Now, paying for your prescriptions works a little differently. When you get to the pharmacy, you simply show your health plan ID card. The pharmacist will access your plan's information and provide you with the discounted prescription price. You can then pay using your HSA debit card. The whole process is very simple and easy to use. Electing a high-deductible health plan will give you power over your own healthcare costs, transparency to help you manage your healthcare choices, and a pre-tax savings account that will be there when you need it.